All right. So for topic 3, we're now talking about our policy provisions. So for these provisions, what we want to know is that whenever we have life insurance, right, there are specific policies within the contract in order to protect the interests of the insured, right, the policyholder, and the insurer. So let's start off by taking a look at the entire contract provision. So this basically states that no external documents or statements can alter the terms of the policy, right? So if the policy has already been issued, right, no matter if it's the insured or the insurer, right, they can't alter the policy, right? Because it's already been issued. And so the application and any attached riders or exclusions constitutes the entire contract, or the entire agreement, right? There can't be any external altercations after when it has been issued. Okay. Now, we also have number 2, right, our insuring clause. So the insuring clause specifies the insurer's promise to pay benefits, right? So if we just think about that I, right, insuring, insure, right, it's the insurer's promise to pay any benefits. Okay. Now, we also have the consideration provision, and we've already seen this before with like the elements and characteristics of a contract, right? And so this is the exchange between the insurer and the insured, right? So what is that exchange? Well, the insured, right, they need to pay the premiums, right? Or the policy holder, right? If they're different. But consideration is premium payment. And for the insurer, right, it's the promise to pay for covered losses, right? And that's specified, oopsies, specified in the insuring clause, right? They are legally bound, remember, to pay benefits, right? They are legally bound. The insured isn't legally bound. The insured can decide, I'm going to stop paying benefit premiums, right? But the insurer is legally bound, as we've talked about, to pay for any covered losses. Okay. Now, when we look at the free look period, right, this is usually 10 days, right, during which the policyholder can review the policy and return it for a full refund if they're not satisfied for any reason, right? So allows them to take a look at the policy, okay, and decide if they want to keep it or not, okay? With the owner's rights, this refers to the privileges and controls that the policyholder has over the insurance policy, right? So maybe includes naming and changing beneficiaries, and we'll specify in a moment what are the ways to name beneficiaries, right? Borrowing against the cash value, we'll also take a look at that too. And also surrendering the policy, right? Surrendering the policy too. So if they decide to stop paying premiums, as I mentioned, what will happen, right? What will happen to the policy in that case? So let's look at first premium payment. So premium payment can be broken down in 3 major topics that we want to take a look at. The first is the mode, right? So it permits the policyholder to select the timing of premium payments, right? Do they want to do it yearly, monthly, right? Quarterly? And as the agent, right, you want to negotiate with the client on that. And usually, right, if we pay it monthly, it will usually on average be cheaper than if we pay it if we pay it semi-annually, it'll usually be cheaper than monthly because if we pay it monthly, there'll be additional charges, right? Related to billing, collecting premium payments. Okay. So a key part is really looking at, right? Usually for most policies and most insurers, there's something called an illustrator, and you're able to modify. Ooh, the face value, right? Or how often I pay the premiums. And C, on average, how the pricing will change, right, over time. And that's really useful. B is the grace period, right? So this is where after the premium has, or premium due date has passed, right, there is 30 days for one to pay the overdue premiums, right? So it's like the grace period. Think about grace, right? I'm giving you some grace, even though the due date has passed, right? Now, please don't get this confused with the free look period, right? Students often get this confused. The free look period is 10 days. The grace period is usually 30 days. Okay, so they are different. They are different. We also have C. Okay, C is the automatic premium loan provision, right? Part C of premium payment here. So this is another thing that we want to focus on. And this is very important because it allows the insurer to automatically use the policy's cash value to pay for overdue premium, right? But this way, it prevents the policy from lapse. So policyholder can decide to allow, right, the insurer to do that in order to prevent the policy from lapsing. But for sure, right, then the insured or the policyholder would have to pay back, right, the cash value that was utilized, right? Okay, so remember how I talked about with owner's rights, right? There are some ways that, the owner can name, can change beneficiaries, but what are some ways to do that? Well, that's where we talk about beneficiary designation, and there's a couple. There's a couple types of beneficiary designations. Okay, so let's first look at primary versus contingent beneficiary. So for the primary beneficiary, this is the person that's first in line to receive the policy's death benefit. So if, right, this might be your dependents, right, something that you're really familiar with. Well, contingent beneficiaries are individuals who are second in line to receive the benefit only if the primary beneficiary predeceases the insured. This might be extended relatives, right? Extended relatives. For example, now we also have something else called revocable versus irrevocable beneficiary designations. So revocable beneficiary designation can be changed by the policyholder at any time without the beneficiary's consent. But with the irrevocable, right? Think about the prefix irre, right? Irrevocable, right? That means the policy owner cannot change the beneficiary without their consent. Okay, we have primary contingent, but we also can look at it from revocable versus irrevocable, right? Perspective. But this is from right, like knowing who receives it first, right? Who receives, right? This is more talking about that, and this is more talking about, right, can change, right? Can it be changed or not, right? So I just want to think about that when we're studying, right, what these terms are if they're new to you. We also can look at the common disaster provision, right? So this is where the insured and primary beneficiary die in a common accident. So if this happens, right, presumes that the beneficiary died first, right, ensuring that the contingent beneficiary receives the benefits, right? So if, right, one condition that we've just talked about is that the contingent beneficiary can only receive benefits if the primary beneficiary predeceases the insured. But if they die in the same accident, right, it assumes that the primary beneficiary did die, right, did predecease the insured. And so that ensures that the contingent beneficiary can receive the benefit. So common disaster clause, just think about the same accident, right? The same death at the same time, but it assumes that the primary beneficiary predeceased the insured. Now, often minors are named as beneficiaries, right? And so oftentimes there is a guardian or a trustee, right, that manages the proceeds until the minor reaches a legal age. Okay. And then lastly, right, primary and secondary beneficiaries, you don't have to name them individually, right? You can say, oh, all of my children, right? And so with some of the policies, you also have that option, right? You also have that option as well, you know, to name individuals by class rather than by name. Right. Now, let's take a look at this beneficiary exploration task, right? So what happens if when John owns life insurance policy, however, on June 10th, right, his wife, the primary beneficiary, passed away due to natural causes. And on June 15th, his sons, the contingent beneficiaries, died in a car crash due to reckless driving. On June 16th, even worse, John died due to have a heart attack. However, he didn't name any other beneficiaries. So the primary beneficiary passed away, secondary or contingent beneficiary passed away. What happens now? Well, take a moment to think about it, research it. What happens to death benefit? Where's the money going to go? All right. So the answer is that it's going to go to John's estate, right? John's estate. I should write here, John's estate. So, right, the estate, remember, if you think about like a will, right? If you have seen someone's will, right? Their will say, oh, all my estates will go to whoever, right? So estate is just accumulation of all of someone's assets, right? So life insurance, the death benefit, that is an asset. That's an asset. So we know that if you are into law, right? If you know a lawyer, then you can ask them, right? What happens with the estates? And it's something that's really interesting, right? That knowing that, okay, the death benefits are now going to be distributed according to the will, right? The will that was negotiated between client and their lawyers. Okay. Now we also have reinstatement. So remember that what happens if, the policyholder decide to not pay the premiums anymore, right? Because they can do that, right? They're not legally bound to pay premiums. But reinstatement allows a lapsed policy to be put back in force within usually 3 years. Okay, 3 years after it has lapsed. So it provides another opportunity for the policyholder, provided that they pay any premiums and interest that was overdue, right? And meet insurability requirements, like medical requirements that way. Now, we also can talk about policy loans, withdrawals, and partial surrenders. So with policy loans, right, sometimes a policyholder might need to borrow against the cash value, right? Why? Well, there might be an emergency, right, in which they need to borrow against the cash value. Remember, cash value is a form of like living benefit. So you can borrow against it, right, throughout the time that the policy is active. We do need to know the interest rate, and this changed between states. This is for Georgia, but that can be different for your state. You have to know the interest rate. That's really important. They can throw that question in there very often. If that's not one question, but hey, it can determine if you pass or fail the exam. So please make sure to go back to your course for that. And withdrawals and partial surrenders. So withdrawals include, right, taking a portion of the cash value and not paying it back, right? So in contrast with policy loans, right, you're loaning it, we're paying interest, right, and you pay back the original amount as well. But with the withdrawals and partial surrenders, right, you are essentially taking out a cash value portion of it, but you're not paying it back, right? So if you're not paying it back, then your death benefit would decrease, right? That's important, right? If you're not paying back the cash value, then your policy's death benefits can increase, right? Because although the cash value is a living benefit, it's still expected to be paid back, right? You still have to pay it back. So if you withdraw it, if you partially surrender your policy, then your death benefit will be decreased. All right, and then we're looking at our non-forfeiture options. So what are non-forfeiture options? Well, they're guarantees built into life insurance policies. So the purpose of this is that if the policyholder decides to totally stop paying premiums, like totally stop paying premiums, what are some ways that they can still, right, obtain benefits, right? Some sort of benefit or some sort of continuation of coverage because they've already paid premiums maybe for 5 years now, right? So what happens? What happens now? Because I've already paid maybe thousands and thousands of dollars for premiums, and due to some circumstance, I can't pay it anymore. So what happens now? What happens? Well, the first option is the cash surrender value, right? So this allows the policy holder to surrender the policy in exchange for its accumulated cash value. So what happens is the policy is terminated and the insurer pays the depository cash value minus any surrender charges or outstanding loans. Okay, so that's one option, just to receive cash, right? To receive cash, and that's a way that they can kind of surrender the policy, totally surrender the policy due to not paying premiums. Now, there's two other ways or two other results besides from the cash surrender value. The first way is reduced paid up insurance. So let's look at this term, reduced paid up insurance. So this is where the policyholder uses cash value to purchase a paid up insurance policy with a reduced face value, right? Hence reduced. But no further premiums are required and the new policy remains in force for the insured's lifetime. So what's the difference with this? Well, compared to like traditional life insurance policies, yes, it does remain in force for the insured's lifetime, but it's with a reduced face amount, right? So if it's with a reduced face amount, that should make sense, right? Because they're not paying premiums anymore, right? They're not paying any more premiums. So basically, right, it's just using the premiums that the policyholder has paid maybe for the last 5 years and then decided to stop paying, right? It's using those 5 years worth of premiums to kind of fund this reduced paid up policy. Now, another way that those funds can be used is, right, it uses the cash value to purchase a term insurance policy with the same face amount. So you can see that the reduced paid up insurance is kind of different from the extended term insurance, right? The extended term insurance, right? The face amount is the same, but the coverage period is short. It's only a term insurance policy. Okay. So we kind of see that with B and C, right? They're kind of like flipped in terms of how much they are worth, right? What's the face amount? And also the period of coverage. So we need to know these payout options. And I put a nice diagram here, right? I recommend that you take some notes, right? You write notes under them, right? You talk about the similarities and differences between them. And if you're curious to learn more about the specifics of them, you can always refer to the internet, to your Excel course, and they'll have more information as well. But for the exam, we just need to know our 3 options and their characteristics. All right, now let's talk about dividends. So what are dividends? Dividends are extra funds that an insurance company may return to the policyholder each year they are enrolled in a participating policy. So the first thing we all know is that they're not guaranteed. Okay, they're not guaranteed. Not guaranteed. So it would be a violation of advertising code if I say that they're guaranteed. So we've looked at that in topic 2, right? But it is a violation of code if we say that they're guaranteed because they're not, right? They're only given to policy holders if they're extra funds. And also, they are only existent in participating policies, right? Not policies owned by stockholders. So they are only existent in participating policies or participating insurance companies, all right, not stock insurance companies, right, which are owned by stockholders. So what are some ways that one can utilize dividends? Well, for sure, just receive it in cash, right? Receive it in cash. But we also have reduction of premium, right? So dividends can be used towards future premium payments. It can accumulate at interest. Okay. Now what we want to know is right here. Interest on dividends is taxable, even though dividends themselves are not. That's very, very important. We need to know taxation. It's a really important part of the course. So make sure to understand that. Okay, I'm going to put a star by it. And the fourth option is paid up additions, right? So dividends can be used to purchase additional paid up insurance, right? So paid up insurance basically means, right, we're increasing the policy's death benefit and cash value. Okay, increasing the policy's death benefit and cash value. Okay, so now let's look at the incontestability clause. So this is a very interesting clause. So it states that after a certain period, usually 2 years, okay, the insurer cannot contest or avoid the policy based on misstatements or omissions in the application, except for fraud, right? We want to know 2 years. That's very important, 2 years. And the exception to that is the misstatement of age and gender provision. So if the age or gender is misstated, right, the insurer will adjust the benefits to reflect what the premiums would have purchased at the correct age, right? So if on the application you said that you were 30 years old, but in reality you were 40, right? Then if the insurer found out, then they will adjust the benefits to reflect, right, what the premiums at 40, right? Your actual age, not your made up age, your actual age would have purchased. So now let's look at assignment. So sometimes, right, there might be a need to transfer the rights to another party, right? Especially when we talk about business type policies, right? With life insurance. And so there's two types of assignments, right? Assignments think about transferring, assignment, transferring. You always want to try and relate these terms to another word that you're more familiar with. Absolute assignment is the transfer of all rights. Collateral assignment is the transfer of some of the rights. Absolute versus collateral. You should need to know that. Okay. And then something else is that suicide clause. If the insured commits suicide within a specified period, then the insurer will not pay death benefit, but will fund the premiums paid. So I think there was an incident in the past, right? A couple years ago, maybe 10, 20 years ago, or maybe even more far back than that. I've heard a story where there's someone who committed suicide on an airplane, and I think there was an incident with that, and they did that in order for their family to still be able to obtain death benefits after his death, right? So that his family is more well off, right? If you're interested in that, you can look back into that story. I kind of distinctly remember it. But regardless, right, the suicide clause prevents that from happening, right? It deters that activity, right? That type of thinking, because it prevents individuals from doing that. Although, right, the intention is to allow, right, their family, right, the beneficiaries to be well off, but still, right, suicide is usually kind of excluded, right, from coverage within a period of time, right? So that's usually 2 years. All right, settlement options. So there are various ways that policies death benefit can be paid out to the beneficiary. So we've looked at designations, but what are some ways? Well, there can be lump sum, interest-only payments, fixed period payments, and fixed amount payments. Also life income payments too. Okay, so there's all different types of ways that can be paid out. Pretty self-explanatory, right? Like lump sum, fixed period, fixed amount, or life income just means for the entire life of the beneficiary. And it really just depends on the policy. Okay. And then number 16, we're talking about accelerated death benefits. So it allows the policyholder to receive a portion of the benefits early if diagnosed with a terminal illness. This is kind of similar, right, with our long-term care rider, right? But it isn't exactly the same, right? This is more of a provision, and it is only if diagnosed with a terminal illness. Okay. And then after that, the remaining beneficiaries would be paid out to the beneficiaries as usual. So to give you guys a quick summary, I just want to mention something real quick. Please make sure to review through these terms, right? Assignment, settlement. People get them confused all the time, like assignment versus settlement. Ooh, that's kind of confusing, right? Just pay attention to the specific details of these terms and their conditions. All right, let's take a look at questions 1 and 2, and we'll go over them shortly. All right, so for question 1, the payer benefit rider provides which of the following benefits? Well, this is a review question from topic 1, right? I like to give these review questions so that we always are thinking about it. And it would be, right, temporary waiver premiums from the payer die until the insured, usually a child, right, reaches a certain age. Number 2, right, the answer would be 9,500, right? Because we see that the interest was already paid, right? But the amount that the insured borrowed, right, wasn't paid back, right? Wasn't paid back, didn't repay any part of the loan. So remember, if that happens, we talked about like withdrawals, right? And so that would be subtracted from the face value of the policy, right? That would be subtracted from the face value of the policy or the death benefit. So 10,000 minus 500, right, would give us D. Okay, now let's take a look at questions 3 and 4. I will go in them shortly. Okay, so for question 3, we can see that this is we have to refer back to the incontestability clause. And so if we remember, right, I highlighted this and bolded it. That means you really need to know it. It would be C, right? 2 years. And 4, right, that would be the entire contract provision, right? So that no external documents can alter the policy, right? The application is the policy and any riders as well. Okay. So no external documents can alter it after it has been issued. Okay, let's take a look at questions 5 and 6 now, and then we'll go over them shortly. Okay, so for question 5, we're talking about what? We're talking about transfer of ownership rights. That's assignment, right? Assignment provision. Right? Assignment provision. And remember, we had the absolute and we also have the collateral assignment. So please pay attention to that. Types of assignment. For number 6, in life insurance, the free look provision, right? Remember, the free look provision is usually 10 days. Begins on the what? On the date of the policy delivery. That's very important. We count 10 days from when the policy was delivered, right? Because that's when it's in the hands, right, of the policy owner, right? So that's when that period starts. All right, let's take a look at questions 7 and 8, and we'll take a look at these shortly. Okay, so for question 7, right, the ways in which the proceeds are paid out, right? So that would be settlement options, right? Remember, you have to review back to them, right? Review back to them, these provisions. All right, question 8 is a very good question because it is really applicational. You really need to think about, right, what happens in a adjustable life policy, right, which is like universal life, for example. If the policyholder makes an additional premium payment, what would happen? except, right? So the policy may be affected in all of this except, right? All this is going to happen except what? So you'll see these type of questions often too. We want to think about, well, the premium paying period may decrease. That's correct, right? So in this question, it would be incorrect, right? Because we're thinking about which is false, right? Except what? The value of the non-forfeiture options may decrease. Ooh, may decrease? Is my cash surrender value going to decrease if I paid more? No, right? If I pay more premiums, I expect to have my, cash surrender amount be greater, right? When I surrender the policy. So this is wrong, so it's correct, right? In this case, right? Because asking about except what? What happened? Length of coverage may decrease, right? That's true. And the length of coverage may increase, right? That's true. And this is face amount may increase. That's true. Okay. So we want to just apply what we talked about with like non-forfeiture options, right? What we talked about with premium payment, with face amount, with coverage, and apply that all together. So we can see that with some of these exam questions, they can be a little bit contextual and it's not all definition based like question 7. So please make sure to review back to these. And then going through these it's really helpful, right? To go through some of these practice questions as well. Okay. And I think these are our last 2. And then before I finish with something else, let's go through 9 and 10, and then we'll go over them shortly. All right. So for question 9, we want to see, right, who received the policy proceeds. Okay. And it will be the children, right? The children, the secondary beneficiaries or the contingent beneficiaries. You'll see both on the exam, most likely, okay? And then for 10, right, we know that it would be the cash surrender value because they no longer want insurance coverage, right? So just make sure that you read through these questions carefully. Read through these questions really carefully. All right. So to finish off, I want to talk about another important concept is exclusions, right? So sometimes, right, due to war, aviation, and dangerous occupation, right, these conditions might not be covered under life insurance. So there won't be death benefits, that are paid out due to work accidents or death from war, right, or aviation accidents. And so these exclusions are there in order to control costs. But there are also other policies and riders that one can add on to cover these as well. With dangerous occupation, there's often something called like workers' compensation that can sometimes pay for that. There's also other more specific insurance policies that would pay for that would cover these exclusions too. But oftentimes, for more general life insurance policies, these are excluded. So they're called policy exclusions. All right, so that's all for this topic in this module. Good luck with all of this. Just make sure this is one of more dense concepts, so just take some time to review it. And then I'll see you guys back around for the next module.